Alright, so let's get right into it. We need to talk about investing. For a lot of people, the word investing sounds complicated, maybe a little intimidating, or like something that's only for the super rich people you see in movies. But here's the honest truth. Investing is one of the most powerful tools you have for building wealth and securing your financial future. It's the difference between working for your money your entire life and having your money start working for you. Seriously, that's the whole game right there. It's about making your dollars generate more dollars, even while you're sleeping, eating, or let's be real, watching YouTube videos about finance. This isn't about getting rich overnight. It's about building sustainable wealth over time. The reality is, getting started is simpler than you think. The journey to financial independence isn't a sprint, it's a marathon. And like any marathon, the most important step is the first one. The goal of this is to break down the barriers and show you that anyone, and I mean anyone, can start investing. You don't need a fancy degree in economics or a six-figure salary to begin. What you do need is a solid plan and an understanding of the common pitfalls that trip up so many beginners. We're going to talk about 3 specific, very common errors that can derail your progress before you even get a chance to build momentum. My goal here is to give you clear, simple, and actionable advice that you can use immediately. We'll break down each mistake, look at a real-world example of what it looks like in action, and then I'll give you the straightforward, no-nonsense strategy to avoid it completely. This is the stuff I wish someone had sat me down and explained to me when I first started out. By the end of this, you'll have a much clearer picture of how to approach investing with confidence. The secret is about consistency, discipline, and avoiding unforced errors. It's about playing the long game and not letting fear or hype dictate your financial decisions. So grab a cold brew, get comfortable, and let's dive into how you can start your investing journey on the right foot and avoid the mistakes that cost others a fortune. Let's get started. Alright, let's get into the first major mistake, and honestly, this one is probably the biggest. It's letting your emotions drive your investment decisions. The stock market is naturally volatile. It goes up, it goes down. On a good day, the market is up, your portfolio is green, and you feel like a genius. On a bad day, the market is down, everything is red, and the natural human instinct is to panic. This is where the trouble starts. Your brain screams, sell everything before it goes to zero. That is your fear talking, not your logic. This emotional response comes from 2 very powerful forces: fear and greed. When the market is crashing, fear takes over. You see the value of your investments dropping, and you imagine losing all your hard-earned money. On the flip side, when the market is soaring, everyone is talking about a hot new stock, greed kicks in. You get a major case of FOMO, fear of missing out. Here's a classic example. Let's say you invested $10,000 into a solid S&P 500 index fund. For a year, everything goes great. Then suddenly, the market hits a rough patch. There's some bad economic news and the market drops 20%. Your $10,000 is now worth $8,000. Panic sets in. You watch the news, see all the negative headlines, and decide you can't afford to lose anymore. So you sell your entire position for $8,000, locking in a $2,000 loss. So, how do you combat this powerful emotional response to market swings? The solution is surprisingly simple. It's something I talk about all the time. Set it and forget it. The best way to take emotion out of the equation is to automate your investments. This strategy is called dollar cost averaging, DCA. It means investing a fixed amount at regular intervals. $100 every single week. $500 every month, no matter what the market is doing. The second huge mistake that I see countless new investors make is a lack of diversification. You've probably heard the old saying, don't put all your eggs in one basket, and in investing, this is one of the most fundamental rules you can follow. What this means is concentrating all of your investment capital into a single stock or a single, very narrow sector of the economy. Maybe you work for a tech company, so you decide to put all your money into that company's stock. Or maybe you hear a ton of hype online about a particular revolutionary company and decide to go all in, betting your entire savings on its success. This is incredibly risky. While it might feel exciting and you might dream of that one stock turning you into a millionaire overnight, the reality is that you are exposing yourself to an immense amount of unnecessary risk. Individual companies can and do fail. Unexpected competition, a major scandal, bad management decisions, a simple shift in consumer trends that makes their product obsolete. If all your money is tied up in that one company and it goes under, you could lose everything. Let's use a simple, relatable example. Remember companies that were once giants in their industry like Blockbuster or Sears? Imagine it's the early 2000s and you decide that video rentals are the future, so you invest your entire life savings into Blockbuster stock. But then, a small company called Netflix comes along with a new business model, and suddenly, the entire industry changes. Blockbuster fails to adapt, and its stock price eventually goes to zero. If you were fully invested in Blockbuster, your entire investment would have been wiped out. So, what's the simple and effective solution to avoid putting all your eggs in one basket? It's diversification. The easiest way to achieve this is through low-cost index funds or ETFs, exchange-traded funds. An index fund is a mutual fund designed to track a market index like the S&P 500. The S&P 500 is made up of 500 of the largest, most established U.S. public companies. Tech, healthcare, finance, consumer goods, you name it, a cross-section of the entire U.S. economy. When you buy a share of an S&P 500 index fund, you're not buying one stock. You're buying a tiny piece of all 500 companies. Think about that for a second. One purchase equals instant diversification across hundreds of top businesses. This is the strategy recommended by Warren Buffett for the average person. You get broad diversification without the headache and risk of stock picking. You're betting on long-term growth of the whole economy, not one company. This brings us to the third classic beginner mistake, trying to time the market. This is the idea that you can somehow predict the market's short-term movements and consistently buy low and sell high. It sounds great in theory, right? You wait for the market to hit rock bottom, pour all your money in, and then sell everything right at the peak before it crashes again. If you could do this successfully, you would obviously make a fortune. The problem is, it's practically impossible to do consistently over the long term. Not even the most brilliant financial experts and professional fund managers can do it reliably. Market timing is a fool's errand because it requires you to be right not once but twice. First, you have to correctly predict the exact bottom to buy in. Second, you have to correctly predict the exact top to sell out. Let me give you a very common example of how this fails. An investor, let's call him Tim, thinks the market is overvalued and due for a crash. So, he sells all his investments and holds cash, waiting for the dip. The market, however, continues to climb for another year, and Tim misses out on significant gains. Then, the market finally does drop by 15%. Tim thinks, this is it, but he hesitates, thinking it might drop even further. While he waits for the absolute bottom, the market suddenly rebounds sharply. Before he knows it, the market is back to where it was before the dip, and he's still sitting on cash, having missed both the gains on the way up and the recovery on the way down. So if trying to time the market is a losing game, what's the winning strategy? Burn this phrase into your memory. Time in the market beats timing the market. Don't jump in and out. Invest and stay invested as long as possible. Let compounding and the economy's long-term upward trend do the heavy lifting. Your greatest asset as an investor is time. Short-term volatility happens, but the market has historically trended upward over decades. Crashes, recessions, wars, crises, the market has recovered from everyone and reached new highs. The practical application, dollar cost averaging. Invest a set amount regularly. Ignore perfect timing. Every payday is the right time to invest. So there you have it. The three most common and most destructive investing mistakes that beginners make are letting emotions dictate their decisions, failing to diversify their investments, and trying to time the market. Remember the solutions. Automate your contributions, dollar cost averaging. Stop checking your portfolio every day. Invest in broad, low-cost index funds. Be the tortoise, not the hare. Investing is a marathon, not a sprint. There will be bumps. There will be scary down markets. With a solid plan, you can navigate volatility with confidence. You're playing the long game. Your goal isn't to get rich quick, it's to get rich for sure. Take that first step, set up your plan, and let your money work for you. You can absolutely do this. If this helped you avoid these costly mistakes, hit that like button and subscribe to be the first to be notified of our next video on building your financial future.